Welcome, everyone. I am Michaela Doyle with the Kellogg School of Management. Thank you for joining us today for our series, This is Kellogg, Accounting, Information Asymmetry, and Access to Credit in Developing Economies with Regina Wittenberg-Moerman. This virtual This is Kellogg series showcases Kellogg thought leadership and initiatives important to the future of the school. You can catch up on prior webinars in this series at our virtual events page on the Kellogg alumni website. We will put a link to that site into the chat now. Today's presentation will last 1 hour, and we encourage you to submit questions anytime using the Q&A icon at the bottom of your screen. And we will incorporate audience questions into the discussion as time permits. I am now pleased to introduce Regina Wittenberg-Moerman. She is the Stanley Gradowski Professor of Accounting Information and Management and Drake Faculty Scholar. Regina specializes in debt contracting and trading, banking, reporting quality, disclosure, and developing economies. She is the recipient of numerous awards, including the Best Paper Prize by the Journal of Accounting and Economics and Dean's Award for Research and Excellence from USC Marshall. Regina is the senior editor of the Journal of Accounting Research, and she also served on the editorial board of the Journal of Accounting and Economics and Journal of Accounting Research, and is a referee for numerous journals, including the Accounting Review, Review of Accounting Studies, Journal of Finance, and Journal of Financial Economics. Welcome, Regina. Thank you so much for speaking with us today.
Thank you so much for the introduction, and hi all. I'm very happy to be part of this Kellogg webinar. I started at Northwestern and Kellogg this summer. I'm very excited to be here, and I'm very much looking forward to sharing my talk with you and my papers with you. So the topic of my talk is accounting, information asymmetry, and access to credit in developing economies. And I will talk a little bit about this topic in general and about my research specifically. As you probably know, if you remember a little bit from your accounting classes that you took probably a few years ago or many years ago, accounting research is dedicated to the study of firms' financial reporting, disclosure, and information systems. And majority of accounting research is done in developing economies, and there's very clear reason why, because we have a lot of data, right? We have companies, we have corporations, we have a lot of other resources to explore this topic. However, very little accounting research has been done so far in developing economies, and I view this as the big opportunity because accounting researchers, including me and my colleagues, can potentially contribute to better understanding of information frictions in these economies. And why information frictions are important? Because low information frictions can facilitate access to credit and capital in generally and improve welfare of households in developing economies. Just before we talk a little bit more about developing economies and access to credit, let's look at this very interesting image taken by the photographer Johnny Miller. This is the aerial image of rich and poor cities in South Africa. And it shows a big, as you can see from the photo, a very big divide between the two. And one of the very important reasons for this divide is access to credit. Access to credit is critical to economic development and growth. And when households or companies or cities don't have access to credit, you will see a very big divide between rich and poor. And one of the leading causes for this inequality, again, is access to credit. And the biggest problem is that when people don't have access to credit, this inequality can even continue and persist over multiple generations. And the real issue is if you look at the global economy, more than almost 1.5 billion adults are unbanked. And what I mean by unbanked, they don't have any access to formal financial system. No banks, no formal financial institutions. And we somehow need to resolve this issue because not having access to credit is very detrimental to households and to economies in general. Before I go more into developing economies and the issues we are facing in developing economies, I think it's very important to remind us about access to credit in developed economies because we take it for granted, right? We know we can go to bank, we know we can potentially go to fintech and get credit. So let's see why it's so easy in developed economies and why it's much harder in developing economies. We know that there's information asymmetry, right? If you would like to take a loan or a mortgage, We know more about ourselves than the lenders know about us. So this information asymmetry impedes credit provision. But in developing economies, we have very well functioning financial and legal systems. So lenders have access to a variety of information sources to help them mitigate information about borrowers that would like to borrow from them. For example, if you think about corporate lending or firms, they would like to go to a bank or to syndicate consortium or to fintech and take a loan. They will provide lenders with financial statements. They can send them their covenant compliance reports. There are also analysts that cover the firms that provide more information. And we also have business press that is analyzing companies' performance. Even if you look about household credit, there's a bunch of information lenders can use. First of all, we have credit bureaus, right? All of us know if you ever took a mortgage or even a car loan, there we have all of us are rated by multiple credit bureaus, and we have a credit score that reflects about our past performance. We also have employment and income records, and we have banking history, which all that can go to the lender to assess our credit worthiness. However, when we go to developing economies, these rich sources of information are mostly not available. Many developing economies lack well-performing formal institutions. Majority of households do not have credit scores. They are not rated by credit bureaus. They don't have access to financial system. They don't have banking records, and most of them are employed informally. So when the lender would like to give a loan to a household or to small or medium corporations, it's very hard to do because how would you assess the credit worthiness of this household or the company if you don't have enough information about them? As the result, all these borrowers have very limited ability to borrow from formal financial systems. And the big issue that we are facing as researchers and many financial institutions as IMF are facing is how we can help household and small businesses in developing economies to get access to credit and improve their financial welfare. I would like to introduce you three of my recent research papers that touch on this very important topic in developing economies, is access to credit. My first paper is called Digital Lending and Financial Well-Being Through the Lens of Mobile Phone Data. This paper is co-authored with AJ Chen from University British Columbia, Marie Eventov from UC Berkeley, Jinku Kang from Harvard. I would like to mention that both AJ and Jinku, my prior PhD students, and I'm very proud to keep working with them on very interesting research. This paper is about digital lending. This type of lending has generally reshaped the consumer credit market in many developing economies over the last 2 decades, including Egypt, Kenya, India, Philippines, and many other countries. I just told you the problem that lenders are facing in developing economies is lack of data sources, and this is the primary reason why it's so hard to get credit in these economies. But very interestingly, most people, even if they don't have any access to banks or financial systems, they have a mobile phone. And what these digital lenders are doing, they're using non-traditional digital data or data primarily from your mobile phone and machine learning algorithms to create an alternative credit score. So imagine again, there's no credit history, there's no formal employment, but let's lenders connect to your phone, and let's put some privacy issues aside for a minute. They know how many people you have in your contact list, you know where you travel, they may know some other potential information, maybe your activity on social networks, and they are able to develop a credit score like a credit bureau, but they don't use information that credit bureau are typically using. They are using mobile phone information. What happened, these alternative credit scores were very successful, and they allowed these digital lenders to issue credit to millions of individuals without any prior history of traditional credit scores from credit bureaus. Um, so it's good, right? I just told you we need to mitigate information asymmetry. We need to provide lenders more information. And this is exactly what happens with digital lenders because they can source information from mobile phones. However, there's still a concern that some of these lenders at least may be predatory, and it may actually make borrowers worse than better. And this is primarily because, and I'll talk more about it in the future, these loans are extremely expensive. So we worked with the biggest digital lender, one of the biggest digital lenders in Kenya. This lender is based in US, actually in California, but most of the lending activity, or all of the lending activity, to be honest, is in developing economies. And lender already served more than 8 million borrowers worldwide, including more than 3 million borrowers in Kenya. And what we do in this first research project, we examine if these digital loans issued based on non-traditional digital information and machine learning and other advanced techniques actually enhance borrower welfare or makes borrowers' lives worse than without access to credit. Let's go back to the story. I just told you for the first few slides how important it is to provide access to credit because it increases growth and welfare. And there are a lot of papers in economics and finance that say, yes, more credit, greater financial welfare. However, we need to be very careful with digital loans because, as I said, they are very expensive. Most of them will have an annual rate of more than 100%, and it may impose substantial burden on the borrower. Also, we should remember that borrowers in developing economies, at least many of them, don't have high financial literacy. They are generally poorly informed, maybe poorly informed about loan interest rate and late fees, and it may lead to overborrowing. And also, consumer protection of digital borrowers is pretty weak. At least it was weak until a few years before. It's a little bit better now after a few regulations were imposed. But during our sample period, it was very weak. There was pretty much no consumer protection in these economies if something goes off with digital lender. So let's look what is so specific about digital lenders that was successful in these economies. Let's start with very traditional customer journey if you go to a bank or even to a microfinance institution that exists and operates in these economies. The customer is traveling to branch, then you meet with the representative, right? Then this next step, you have to wait. You submitted all your documentation, you talk, potentially there was an interview with the bank representative, and you have to wait for a bank decision. Sometimes loan officer decides quickly, sometimes there's another committee involved, and you have to wait for the decision. Then you are informed the decision is made, you'll go back to the bank, and hopefully the decision was positive and the customer or the borrower receives the funds. Let's look what's the biggest difference with digital lending. You apply on your phone. You don't go anywhere. You don't meet with any representative. You apply on your phone, and within minutes, you hopefully have a funds in your wallet on your phone. And with respect to lender, we are talking about this decision is typically made within less than 60 seconds. So if you compare it to days or even weeks with traditional access to credit, digital lending is very convenient because the borrower sees a business opportunity and it's a good business opportunity, for example, or if they have really big needs like medical emergency, they can get extra money within less than 60 seconds. Let's look at these loans. They're typically very small, from $1 to $500, and I would say most of them will be below $100. They're very short term, from 1 week to a few months, and again, majority will be a few weeks, and they have very high interest rate, as I already said. Some of you may be familiar with traditional microfinance loans that have been documented to be somewhat helpful in developing economies, but potentially less helpful than was expected. So we compare it to these more traditional microfinance loans. Digital loans have substantially lower transaction costs, right? You don't need to travel to banks. And imagine that some of the developing economies, traveling is costly, especially if the customers potentially engage in agriculture. Traveling to a big city may take a lot of time, money, and effort. Everything is automated and related to non-traditional digital data. No information should be collected or submitted by the borrower. And we just saw that approval and receivership of the fund is almost instantaneous. You can get your money within 60 seconds from application. Let's talk a little bit more about Kenya before I get to what we find. Kenya is very, very important market for our research because generally sub-Saharan Africa has 350 million unbanked individuals, and they account for 17% of global total. Kenya also became an epicenter of fintech innovation because they were the first country where a mobile phone wallet called M-Pesa was developed in 2007. And Kenya has experienced an exponential growth in digital lending since the first digital loan in 2012. I just told you this loan is super expensive. However, the survey by the Digital Lenders Association in Kenya found that they're still very, very helpful or widely used. If they're very helpful, this is what our research will define, but they're at least very widely used. So more than 55% of Kenya households depend on digital lending for business financing. And despite the high cost, majority of them said they're willing to borrow again to invest in their business. And they even said that they will go to digital lenders first, even before asking for credit from family and friends. It just shows you how important this sort of financing is in Kenya. A little bit more about our lender. Everything is done through a mobile app. The borrower download app, open the app, and actually gives the lender access to mobile phone data. What are the typical loan terms? The average loan term is equivalent to $75. As I told you, majority of loans will be below $100. It's very short, 27 days. And for this 27 days, the borrower will pay almost 14% interest rate, which will equal to more than 180 basis point percent APR, which is very, very high compared to what we are used to in developed economies, and there's also late fee of 8%. What is very important for our research and our communication with the lender has a very good reputation in Kenya. It helps borrowers many times when they have urgent needs, such as so you need to go to a hospital, and some people to go to hospital in Kenya, they don't have money to book a cab or to book an ambulance. They go to the digital lender, and they get funding for this very urgent procedure. Also, our lender does not use any unethical shaming techniques. Some of you may be surprised, but a lot of lenders in developing economies, because they have access to your phone data, they know everybody in your circle. So many of them can call your friends and family and say, your friend didn't pay a loan to us. It's very shameful. You should tell him to pay us a loan. Our lender has never engaged in this type of activities. What is also very important, why we decided to work with the lender, is that starting April 2018, the lender did a very interesting experiment, and the lender randomly approved loan applications that were otherwise rejected based on the credit score. So just to clarify, the borrower downloaded an app, opened it, all information was immediately transferred to the lender, and lender's credit scoring model that the lender developed using machine learning said, no, this borrower's credit score is too low. We will not be able to give this borrower a loan. The experiment overrules this decision and say, let's try. Let's give this borrower a loan anyway and see how the borrower will perform. The lender developed this experiment just to test its credit scoring model, but for us it's very crucial because we can avoid a lot of econometric issues or analysis issues that happen in academic research because we have data, but data is not random. So I will not bore you with econometrics. Hopefully you remember something from econometric and statistics classes you took, but I'll briefly explain to you our experiment. We would like borrowers to be very similar, right? We would like to say, okay, one borrower got a loan. It's a treatment borrower. This borrower was randomly approved by the lender despite having a very low credit score. We also have a control borrower. This borrower was also rejected by the lender, but wasn't part of the experiment. We would like to have these two types of borrowers to be very, very similar. So our treatment borrower, for example, took the loan, applied to a loan in April 2019, and was randomly approved. Okay, again, credit score was below the threshold, but was still approved. And applied to another loan in September 2019. We are trying, because of the experiment, find a control borrower who was rejected by the lender, but is very similar to the one who was accepted. And rejected borrower will have a match loan application. How do we match? We match based both on a credit score. Credit scores of these borrowers will be very similar. So the credit score goes from 0 to 1. We require a difference of 0.005, which is tiny, and will also apply around the same time, within 30 days from April 18th. And the same will be for the subsequent loans. So imagine at this point we have two groups, treatment and control. They are very, very similar. They apply to loans almost at the same time. Their credit scores are almost identical, but treatment borrower was approved randomly by the lender because of the experiment, and the control borrower wasn't. So it's very challenging still to continue with this study, because how do we measure financial welfare? We have a great approach, right? We have treatment and control borrowers, but how do we measure how well they are doing after getting or not getting a loan? And as I told you, economic activities is mostly informal in this market, so it's very hard to collect information. Some studies, I would say majority of studies do surveys, and I'll show you surveys in my other two other papers that I'll discuss today, hopefully given the time, that are very costly. And I know myself how costly they are, and you can only reach a small number of households. So what we do in this study, we actually follow emerging literature in computer science that relies on mobile phone data to measure individual wealth. Why computer scientists and economists started looking at mobile data to measure welfare? This is because there are hundreds of billions of dollars that spend on targeting social protection programs. There are a lot of institutions that try to help poor households in developing economies, but it's very important to decide and determine who is poor and who is not, because there are a lot of manipulation that unfortunately households can do to pretend to be poor. So what this scientists in computer science they said, hey, remember, there's no data, but 95% of global population has a mobile phone, and there's a lot of information on the phone. So what they show that using this information, you can actually very carefully measure financial welfare, and not just by individual, but also for example, for a county or for the region or even national wealth. So as a result, a lot of institutions use mobile phone data to improve the targeting of humanitarian and anti-poverty government programs. What we do, we are the first one to use mobile phone data to access financial welfare of individual customers in a credit setting of digital lending. So let's look, this is exactly what we'll be doing. We will be looking at movements and mobile banking, at SMSs, and the people you have in your contact list to measure financial welfare. So more specifically, we look at monetary transactions. As I told you, Kenya was the first country to introduce in developing economies mobile wallet. We can measure monetary amount average per transaction and average daily balances of the mobile wallet from SMS text. So borrowers get a text, we extract text around the numbers, and we can measure these financial numbers. We also look at mobility. There's a big research in economics that show that wealthier people travel more, greater mobility shows that there's a transportation asset, and unemployed people tend to be less mobile. So to measure the welfare, we look at the number of unique cell phone towers that borrower passes and the number of cities the borrower visits. We also look at social network. It's important how many people you contact with, because it can facilitate job opportunities, some information resources, and also stronger networks also help your business opportunities. So what we do, we look at the total number of incoming and outgoing text messages the person has on the phone, the total number of contacts in the phone book, and the proportion of people in the borrower network who took loans from the lender and were pretty good. They paid on time. So the borrower is connected to a strong network. We supplement this very cool data, in my view, also with traditional data that most of other research did, and this is income in employment that borrowers self-reported when they applied to the loan. I know you may be skeptical about self-reported data, but unfortunately, this is most of the data that is used by researchers in developing economies because formal or official data is not available. What do we find? Very good results. Digital loans improve borrowers' financial well-being across all measures that we had: monitor transaction mobility and social networks. We also find that after borrowers get loans from a digital lender, they improve their monthly income and they have a greater chance to be employed. We also have a very interesting cross-sectional results, or by cross-sectional, I mean results across different borrowers. The effect of digital loans is very helpful primarily to borrowers that have limited access to credit. They don't have access to credit bureau ratings and they don't have bank accounts. Digital loans are also very helpful to business purposes. If digital loan is taken to improve the business, it will generate a lot of wealth to the individual. And if people are taking a little bit more credit than the first loan, it will be helpful as well. So we believe it's very positive result because it indicates that, yeah, we found a good source of lending and financing to the borrowers that can help them to grow and develop and improve their wealth. However, we should remember that we work only with one lender when in one country, and there are some caveats. And you probably know there are caveats in any research. Any research is specific to the setting, so we should be very careful not to overinterpret the data. So remember, we talked about borrowers that were rejected. We didn't do this experiment with borrowers who were approved by the system, so we don't know how much they benefit. We believe they still benefit because they're generally relatively poor, don't have access to credit bureaus or financial system. We also need to remember external validity of our findings. We may not get the same findings outside of Kenya or in different institutional or regulatory environments. We hope to get similar findings because borrowers that we had are very representative of other developing economies, but we should be mindful of this limitation. Also remember, our data was from a single digital lender, and we know it's a reliable lender in Kenya. However, lenders may pursue predatory lending, may overcharge borrowers, or may be not transparent about their fees. And this is something we should keep in mind. We still believe that our research is very helpful because we know if the borrowers, if the lender is transparent, support the borrowers can benefit even if they pay this crazy 180% loans. And these loans still benefit their growth, especially if they put these funds into their business. This was the first paper. The next paper will be a little bit shorter given the time limitations. It's actually a series of two papers that I did with my co-author, Remy Tommy from the University of Chicago. And we look at the subsection of the developing economies, and these are informal markets. Informal markets are very important because they're a very big part of developing economies. As I already told you, prior research shows that the importance of financial reporting, auditing, courts in lending decisions, and as I said, these systems are pretty much non-existent in developing economies, and especially if they don't serve informal markets. So in the first study, we try to determine, so how can the access to credit happen? What do we do? What do lenders do in developing economies to give access to credit? And this is informal market. Funds are not, these lenders don't have access to your funds. They're not sophisticated fintech companies that can download and analyze data from the fund. So informal economy is super important, account for 30% of GDP and 70% of employment in emerging markets. They are not regulated. There's low productivity and development in these markets. They have very limited formal sources of credit, and they primarily rely on trade credit, nothing from bank, trade credit. And this was actually from the market where we did our survey. Again, importance of informal economies. A majority of global South has informal employment. What we explore in this paper is actually important role of community membership, and we believe that community is very important mechanisms through which credit is allocated in developing economies. And this is because community plays an important role in formal market, but mitigating information frictions and also facilitating risk sharing across different people in the economy. Our study this time is in India. The map shows you the specific area where we do the study. The market is called Yodu. It's the epicenter of the trade in the region. We surveyed wholesalers, retailers in Badar economy because, as I said, there's no formal source of information. So survey is one of the most typical approaches to research in informal economy. We collected data from 500 traders, a majority retailers, 150 wholesalers. We, as expected, found that most of the transactions are done with trade credit. What I mean by trade credit, retailer comes to the wholesaler, take the goods, don't pay immediately, pay over time when the goods are sold. Retailers primarily don't have access to bank credit. Again, the same problem. They're unbanked. We asked them why. They mentioned a lot of reasons. The most common ones were we don't understand the loan application process, or I don't trust formal financial institutions. They will take money from me and I will pay high rate, get nothing. Or I cannot provide collateral. I buy goods, I sell them. I don't have any collateral. I cannot go to bank. This market was also very interesting, and these are traders in the market. They allowed us to share their pictures. We have 9 communities, and these communities share language, culture, and place of migration. What we find is wholesalers are more likely to offer credit to same community retailers, and they provide them with more credit. What was the most interesting, I think, is that these wholesalers are also very lenient towards same community retailers and generally don't take any actions when these retailers default. More or even more than that, they continue to lend to same community retailers even after they default and don't pay them back. So what can explain it? There should be some mechanism that explain why lender wholesalers help so much to retailers within their community. We suggest a mechanism which is called indirect reciprocity. So you can probably imagine direct reciprocity. As a wholesaler, I help you as my retailer, and when I'm in trouble, you will help me back. It's more complicated than that. Indirect reciprocity means that wholesalers derive benefits from other community members as long as these other community members are aware of their generosity. So imagine this picture in front of you so let's say A is a wholesaler. Wholesaler A helps retailer B, but then when wholesaler is in trouble, it gets help for some other member of a community, which is not a prior retailer, but who knows about generosity of the wholesaler. And this is a very important mechanism in developing economies because of the income instability and lack of sources, formal insurance sources. So if you have some small change to your income and can actually have a very large negative impact on consumption in developing economies because you have no insurance and no other income sources. So to support this indirect mechanism, we did another survey right after the COVID income shock, and we found that wholesalers got a lot of help from their community, but not directly. The help came indirectly, primarily from landlords and suppliers that reduce the rent or reduce the electricity bills to help wholesalers that are known to be helpful to community members. We also show that wholesalers who are more dependent on the community, they're generally weaker. They are more engaged in this mechanism of indirect reciprocity and actually help more their retailer community than wholesalers who are richer. And this is because wholesalers that are weaker actually know that if something happens to them, they will need help from the community in the future. They also find additional support for indirect reciprocity mechanism, and this is about information flows. So it's not enough for you to help your community. You should also make sure that others know that you're helpful. So we found that wholesalers who are more tied to the community are more likely to engage in reciprocity, indirect reciprocity, and how they build a reputation. They're married within a community, so a community knows more about them, and they're also more likely to go to community events. So what the study shows is that there's very few formal sources of information, but wholesalers and retailers who rely on trade credit use some other mechanism to somewhat support the credit allocation in informal economy, because otherwise informal economy cannot be sustained, because retailers don't have enough money to buy goods. They have to take trade credit, sell the goods, and only then repay the wholesaler. This leads us to my last paper for today and another project with Remy, is that yes, it's great. We understand the markets now better. We know how it works in developing economies and informal bazaars in particular. We know that community is very helpful. But what if you need products from somebody who is not part of your community, or you are not well established in your community? What happens then? And the idea in the follow-up question was, what can we do in terms of financial or accounting information to potentially provide these wholesalers to improve access to credit, potentially give credit to those who are outside of a community, or to increase credit to those that are within the community? And to do this, to answer this question, we need to figure out the wholesaler preferences for accounting information that retailers can potentially provide. It's very important to understand these preferences, because the approach that we can take as researchers or government agencies or NGOs will be very different depending on the answer to this question. If there's lack of financial information that we saw in this market driven by education, we need to train lenders and train the borrowers. For example, the wholesaler tell me, yeah, I would like to use the accounting numbers to assess this borrower or this retailer, but I don't know what they mean. Or retailer can say, sorry, I don't know how to estimate my sales. Then we need to some educational courses. However, there may be another reason. They can say, okay, I don't trust these numbers. I don't trust anything that will be reported by retailer. And if this is the main reason that accounting numbers are not used in informal markets, is that we need somehow to design a verification mechanism that will somehow verify information provided by retailers. It may be also that wholesalers will not use financial information, even if provided to them, because of the inertia. They, for generation, use very informal sources of information. For example, if you belong to my community, if your store is next to me, can I go by and observe your trading? And it's much more informative to them than some formal accounting numbers. So how did we answer this question? We designed a hypothetical choice experiment to explore these reasons. What do I mean by hypothetical choice experiment? We provided wholesalers with retailers portfolio. This is sort of imaginary retailers that we created on a paper for the purposes of this research. We gave information on their financial performance and non-financial performance, and we presented all the wholesalers with the choice between two retailers. We had the number of sets of these retailers and asked them to choose the preferred option. This is one of the options we gave to retailers. For example, we said there are two retailers, one from community, Kasi, one from Bengali. We had information, or they didn't have information about profits, yes or no information about sales. We tell them, okay, this is retailer you worked with for 6 to 10 years. This is retailer that you work with for more than 10 years. And this is the credit that we would like you to give. So which one will you use to give credit to? And what we found, that wholesalers do like accounting information. They would use it if it's given to them. And just to mention, we told wholesalers in this experiment the accounting information is reliable. They can be used. And what we also found, that inertia is not relevant. We did a lot of tests to show that. Given the timing, I won't show you the specific test, but that was the conclusion. We also find that lack of financial literacy is irrelevant. These wholesalers and even retailers are pretty good in understanding profits and sales. They can create this information and report it to wholesalers. So what we find is that there's a lack of trust in financial reporting numbers that leads the sparse use of accounting information in credit allocation. To supplement this research, we also look at retailers. It's not enough for wholesalers to accept this information. Retailers should be willing to provide it. We didn't do experiment with retailers because it's irrelevant to them. They don't provide credit, but we did a big survey and we found a very similar issue. Financial literacy is irrelevant, but retailers don't want even to provide financial numbers to wholesalers because they're afraid they will be misused or these numbers will be used for something else, uh, which is not specifically providing credit. And they said, okay, we don't trust this information to be confidential. We know that it will increase our chances to get credit. We know it will give us more credit. We are still not going to give our information to wholesalers. So if you would like to help informal economies, would like to increase credit in informal economies, we should think as academics, as researchers, as governments, as NGOs. We need to develop some mechanisms that will improve the trust in these informal economies so that wholesalers will be able to give more trade credit to retailers and we can increase the growth and welfare in informal economies specifically and developing economies in general. So I'm almost out of time. I already actually covered this slide about our conclusion. So in this research, we need to design a verification mechanism to improve reporting reliability of accounting numbers and somehow ensure the protection of this information. Just to conclude, I'm continuing doing research in this area. My next research project that I potentially may be able to talk to you in the future is actually in China. I'm working with a few very prominent researchers from Chinese University of Hong Kong. And we look at a very different problem. The problem is actually in the specific province in China is not the lack of credit. Actually, financial institutions and the local government would like to give credit to customers. The problem is different. Customers are not taking enough credit, and it slows down the developing of the local economy. As we know, access to credit improves growth, but you should incentivize borrowers to take loans so they can invest in their small businesses and develop the economy. What we do in this experiment, we found that borrowers have some bias. They go to government platform that helps them to connect to banks. The platform, for example, offer them 5 loans and they just choose the first one. And this first one is not necessarily the best one for them or for their business. What we are trying to do in this experiment, we are trying to see if we give them some visual nudges, will they be able to choose the correct loan that serves their business better and it will improve their business and their welfare eventually. I also would like to tell you that if you're working for an organization or for a company or fintech that would like to work with us, we are very happy to develop or design a study with you that will explore issues in developing economies. I'm also working with fintech companies, and developed economies are also a very interesting place to still explore access to credit. So if you have any interest, we will be happy to team with you, to partner with you, and keep our research going forward. And thank you so much for your time. And I am looking forward to your questions.
Thank you, Regina. This has been such a great and informative presentation. We do have some great questions, so I'll start off with the first one. How does the legal framework impact credit availability?
I believe this is related to developing economies. The question, the legal system, as I said, is pretty weak, unfortunately, in many developing economies. And this is one of the issues that potentially can also be explored, how we can improve it. Because if, as the creditor, you don't have credit protection because your legal rights are pretty weak, you will be very hesitant to offer credit. You may not offer credit, or you can offer very little amount of credit. Imagine, for example, the bank in developed economy. You give a loan to a small company provide collateral. So if the loan is not repaid and the borrower in default, as the lender, you still have losses, but at least you can claim your collateral. Claiming collateral when legal system is very weak is almost impossible. So legal issues are very important to look at as well and see if improving lender protection may help with credit. Land and legal system may be also important for borrowers for protecting their information.
Yes, I think we had a question come in related to your answer to this. For the rate, what is the rate of default of these loans, and are they backed by government guarantees?
Okay, I presume actually this was my final slide, and it takes us back very nicely to where we started with digital loans. And because the loans were the first paper, I believe the question is about the first paper. It's very shocking that default rate is very low. When we asked the company what the default rate is on these digital loans, they told us it's 5 to 7%, and we just told them it cannot be true. You just don't measure it correctly, but it is true. And we talked to the lender a lot, and the point was that first, they're a very reputable lender. So if you default in a loan to this lender, they will not give you another loan until you repay, or may not just give you a loan in the future. So customers try to pay back. It's like a relationship lending. The fintech lender was good to you. The fintech lender gave you a loan when you needed it for your business or medical needs, and you pay back because you know they will support you in the future. I also told you this lender is reliable, and customers over time know that the lender is reliable. The lender will not call their friends and family and saying, hey, this person didn't pay my loan back, you should push him to pay. And as a result, it's very low default rate. What I mean by default rate, I just want to clarify, it's final default, right? Many customers will be late on paying back. So they may take a loan and will not repay within 27 days, but they will eventually pay it. It may take 3 months, 6 months, a year, but eventually money will come back to the lender. The lender still lose this because they cannot reinvest this money in other loans until the loan is repaid, but eventually the money will come back.
We have a lot of questions coming in
Okay,
about
I'll
loans
try to
now,
speed
so
up. Yeah.
I'll do one more question about loan, and then we'll switch gears. But are digital loans typically given in the form of cash, or are we seeing the digital loans in cryptocurrencies?
At least we work with our lender, and most of the lenders will do cash. I think crypto is of course possible, but you should remember that the borrowers in specific markets in Kenya and many developing economies are not as sophisticated. Some of them are, but majority are just having like clothing stalls in the market, fruit stalls. And I think given crypto will not be as useful, they need money right now. They got the money within 60 seconds. Within the next 5 minutes, they bought fruits, bananas, or some used clothing, and they are reselling them within an hour. So what I know, at least in Kenya, and most of the digital lenders do it in cash.
Definitely. Okay, so switching gears a little bit, has there been any research on mobile data being used to enhance or supplement credit rating data?
It's super interesting question. Not that I am aware of. For now, majority of banks are using credit bureau data, but majority of fintech companies are using their own systems, and they're using mobile data to develop alternative credit scores. There are banks in developed economies and also in developing economies are now catching up, and they're saying these companies take a lot of business, and most of them are pretty profitable. So why are we behind? So there is some incentives for the banks to pursue similar modeling. And potentially when they do that for customers that have access to credit bureaus or who credit bureau ratings, they will be able to use this data to supplement. But I think in my view, it isn't done yet.
Yeah. We have a question about the information asymmetry. Joe says, does this information asymmetry also exist among U.S. population segments, and have similar techniques been applied in the U.S. to address this asymmetry?
Okay, another excellent question. There are a lot of, as you probably know, fintech companies that are trying to serve population in the United States that was underserved by banks. And yes, there are startups that use some other information about you that is less formal than the typical pay stub or past bank transactions. And we do know that these fintech companies help a lot of people in the United States. For example, with mortgages, right? A lot of people now go to fintech company and provide other information to get a mortgage. However, we should remember the privacy rules and legislation and legal protections. For example, in United States, you will not be able to connect to somebody's phone and get entire data on the person's life. This is definitely prohibited. So when we looked at our paper, it was actually very interesting that we were thinking, on the one hand, from our point of view of people living in developed economies, what these fintech companies do in Kenya is violation of the privacy rule, right? To some extent, from our perspective, it's not legally in Kenya. It's legal to do that, and the borrowers give them permission. But on the other hand, this is the only way to give people credit. So this is my response. Yes, there's fintech options here, but they are not using your personal data from your phone.
Yeah. We had a question about longevity and the wholesaler. What is the typical longevity of the wholesaler, and what is the usual longevity of the borrowing business?
These wholesalers are very long-term wholesalers in this market, and we were surprised when we interviewed them. They're generational wholesalers. A lot of them there for third and fourth generation, staying in the market and continuing the business of parents, grandparents, and grand-grandparents. Even wholesalers that are new to the market, many of them there for 10, 15 years. So this is their main business. And of course, COVID was a disruption. Many of them stopped selling in the market during COVID. Hopefully, they were able to return. And there was a second part of the question that I forgot.
That's okay. We had one relate back to the inflation rate, and how do you factor in inflation rate before determining that as an interest rate if it's relatively high?
All right. Excellent question. You definitely remember your macroeconomic classes from Kellogg. We did an account to inflation. I know inflation is high, but remember that we have a very short-term period. We are talking about loan that is taken from 3 to 4 weeks. We could, of course, account for inflation that will make your real interest rate smaller, but we don't given the very short-term period. And given our research design that all of these customers are for 3 weeks, not accounting for inflation doesn't bias us in any direction to um, find our results, but it's a very good point.
Yeah. We had a couple about how do financial institutions set those interest rates based on the borrower risk? And then how do they get comfortable with lending to populations under extreme poverty as well?
Um, they determine the interest rate, so they worked with a lot of data. I don't know, but I'm presuming for the first 3, 4 years, they were losing a ton of money, the startup or the fintech lender we are working about, because they were collecting information. They were collecting information, giving loans, collecting more information, and developing a model that can predict the future default rate. This is how they do that. About how comfortable they are of giving loans at such high interest rate, it's super important question. And I am very proud to say that the lender that we are working with, they have the people who is like the entrepreneurs who started the company and everybody who is working there were actually very concerned about this question. And they wanted us to do this independent study. They had absolutely no influence on our results. They gave us the data and said, go with the data. And they wanted to say, we know we give a lot of credit. We know the interest rate are extremely high. We want to know if we actually help the customers. And they do help the customers as we show. And we also were questioning, okay, how can they help because the interest rate is so high? But because there was so little access to credit, the return on a lot of investments in these economies is very high. By selling fruits, you can make more than 30% return. surprisingly, because there's so little money flowing around.
Very interesting. There was a couple of questions about credit scoring, and then it also tied a little bit into AI. How do you leverage credit scoring in emerging economies where this infrastructure does not yet exist or where data is as reliable? And then how can AI be leveraged for that if possible?
I'm sure AI will be very helpful because it just makes our information processing more efficient. And AI is very advanced, but I think the basis for AI is the same as the machine learning algorithms. And just using AI to process all this insane amount of information that fintech companies get from phones or from social medias will just, in my view, make these models more efficient, and hopefully they will help more customers to get loans. They can also decrease the cost of processing this information to the lender, which may potentially decrease the interest rate they're charging.
I think we have time for about one more question. And this one was related to, again, the mobile phone data as well. We had a lot of questions about those.
Yeah.
But are there data privacy concerns for borrowers providing lenders to mobile phone data? Does the lender only have access to mobile phone data while the loan is being considered? And then during the term of the loan, how does that come into play?
Yes, there are privacy concerns. There's no doubt about that. And lately, the Central Bank of Kenya and Central Bank of India and other countries, they imposed restriction on digital lenders because of this concern. It's probably hard to imagine that, but a few years ago, you can just say, I'm a digital lender, I'm giving you a loan. Nobody will ask you, do you have credential? Do you know what you're doing? Are you abusing customers? But it had changed very drastically lately. And to be a digital lender, at least in Kenya, you have to get a permission or approval as a financial institution in Kenya from the central bank. And our lender, of course, got this permission. A very interesting point. Yes, you generally get information from the phone when the loan is outstanding, but some customers don't remove the app, and lender keeps getting access to this information. Borrowers give permission, and absolutely legal. Borrowers give permission to the lender to continue using the information from the app, from their phone. You can say, hey, this is really too much. They're getting too much information because loan is already repaid. But remember, they're always like two sides of the coin. Because they keep collecting information from the phone, it will be easier for the borrower to get more credit in the future. So yes, it's even less protecting the privacy. But on the other hand, it helps the borrower to get more money in the future.
That makes sense. Well, I wish we could get through all the other questions because there were so many to get through,
Oh,
but we're
sorry.
just at time. No, thank you so much, Regina. This was such a great presentation, and to everyone who asked questions, we are very much appreciative of your time today.
Thank you so much. It was a pleasure to have all of you here today. If you are still interested, feel free to email me. If you want your company, organization, NGO to work with us on research, we are happy to do it and help customers to get access to credit or any other developmental issues. Thank you so much. Bye.
You.